Welcome back to New Zealand Property Insights. I'm Paul Roberts.
And I'm Debbie Roberts. We're the owners of Property Apprentice, and as always, we're here to cut through the noise and give you the facts, strategies, and the real opportunities in the current New Zealand property market.
We're coming to you today after the budget last week, opening episode 16 with a total reframing of how real estate value is created in this country, and a new report called Beyond Targets is challenging the old way council builds cities and showing us to spot artificial scarcity and buy ahead of the curve.
It's a bit of an eye-opener. We're also looking across the ditch because Australia's latest federal budget has sent a wave of envy through their investor community. In fact, Australian media is now openly calling New Zealand a real estate tax haven. We'll explain why Tasman capital is eyeing our shores with massive confidence.
And finally, we are breaking down the government's housing reform announced recently. The policy is shifting hundreds of millions of dollars directly into the private rental market via the accommodation supplement, helping Kiwis on lower incomes to cover their housing costs.
This episode's packed with positive news, which we hardly ever get from the mainstream media, so let's get into it. We're kicking off today with a piece of economic research from Dr. Benno Blaschke at the New Zealand Initiative. He's turning the housing conversation on its head by proving that arbitrary council building targets are completely outdated and that the future belongs to price signal planning. This is what's called the new blueprint for smart zoning.
This is a win for common sense. For years, councils have bragged about hitting their bureaucratic quotas, yet prices keep climbing because they weren't building where the people actually wanted to live, or the types of properties that people wanted to live in. The report argues that by looking at the actual price jumps across the cities and city boundaries, we can pinpoint exactly where the artificial scarcity is and unlock the market.
New research titled Beyond Targets reveals that New Zealand cities have frequently achieved their state-mandated housing targets for years without seeing an improvement in underlying housing affordability. The latest REINZ data indicates that national median residential prices slipped a minor 0.6% year on year to $775,000, while sales volumes dropped 7.9% nationally, led by a 14.8% annual decline in Auckland as the market adjusts to a more stable footing.
The report proposes replacing numeric dwellings targets with price-based indicators that measure artificial land scarcity directly at city fringes and zoning boundaries.
Substantial price jumps at city boundaries act as a clear market signal that council rules are treating development permissions as a rationed, scarce commodity rather than meeting actual buyer demand. People such as Auckland Mayor Wayne Brown, urbanist Elaine Batoord, and Housing Minister Chris Bishop have openly critiqued numeric targets, with Bishop labelling the 2 million homes figure a red herring. The initiative recommends establishing a permanent, independent expert panel of urban economists empowered to overrule restrictive council zoning plans that choke productivity and choices.
Again, this lines up with what we've discussed in the last episode about supply and demand. If consent for properties out in the middle of nowhere, or they're the types of properties that nobody wants, they don't solve a true housing demand. Blaschke's idea of using price signals at zoning boundaries seems pretty smart. If a piece of land doubles in value at the exact meter it crosses an invisible council planning line, it proves the council is artificially inflating prices. When we transition to a system that uses price signals, councils will be forced to open up land exactly where people want to live and work.
It could completely change the game. By bringing in an independent expert panel of urban economists to overrule restrictive council plans, the government is creating a much more stable, predictable, and market-responsive environment. It means the artificial barriers that used to cause wild, unpredictable price spikes could be replaced by a smoother, more logical flow of development. It gives buyers the ultimate power to make considered long-term investments based on real economic data rather than political guesswork. And at the end of the day, if the cost of developing is lower due to bureaucracy, it could also help further with the cost of housing.
So segment 2 is the Trans-Tasman Advantage, New Zealand's tax haven appeal. So now let's look at the release from the Australian federal budget. Major Australian media outlets are now declaring New Zealand's appeal as a property tax haven has reached an all-time high.
While Australia has chosen to tighten the screws on their property sector by increasing capital gains taxes and heavily restricting negative gearing, despite seeing how this played out in the New Zealand property market with the removal of interest deductibility and 10-year bright line rules by the previous government, New Zealand is standing out to Australians as a beacon of simplicity, clarity, and pure opportunity for wealth creation. Okay, Kiwis, I hope you're listening because we're going to take a closer look at the facts.
Australia's last budget has significantly tightened the rules for property investors, replacing the previous 50% capital gains tax. Now, remember, that's the discount. So it is after a year of owning the property, you only pay half of. So if the property was $1 million, it went up to $1.5 million. You pay 50% capital gains tax on 250,000, not the whole 500,000 gain. And that would be at your tax rate, etc. So capital gains tax with an inflation adjusted model is a minimum 30% tax rate. So instead of them now previously getting a 50% discount, they're only going to get a 30% discount.
The Australian changes also capture legacy assets bought before 1985 for capital gains purposes. That's going back a long way, isn't it?
Yeah.
And heavily restrict negative gearing, meaning that landlords can no longer offset rental losses against outside income unless they invest in new builds.
New Zealand offers a vastly simpler and more advantageous tax framework for real estate, with no general capital gains tax outside of the standard bright line test of 2 years, no stamp duty and no land tax. Although our tax rules around losses are quite different here with ring fencing rules, etc. So don't forget, in Australia, they've always promoted negative gearing, whereas we don't want to promote that and should never really promote that here.
And for those of you that are wondering what negative gearing is, it's where you buy a negative cash flow property and offset that against your income. In New Zealand, you can't do that. Infometrics and Westpac economists highlight that Australian buyers are completely exempt from the New Zealand foreign buyer restrictions, and a favourable shift in the exchange rate has made Kiwi property look incredibly attractive as a place for property investing. While Deloitte experts note that New Zealand is structurally a simpler and more transparent market rather than a literal tax haven, the contrasting rules have created a strong tax marketing narrative favouring New Zealand.
A survey data from Cotality reinforces that property investors here in New Zealand fundamentally prioritise cash flow and loan serviceability over back-end tax concerns, meaning rules that protect properties' monthly cash flow are the ultimate driver for market confidence. And that is why we prefer that the way the tax system is here stays the way it is, because it just makes sense. Whereas Australia is completely different, but now they're seeing why.
And they'll see the results of those changes.
And it's going to be big for Australia. So when you see the Australian business owners and investors looking across the Tasman with what the media calls genuine envy, it tells us everything you need to know about the balance in our system. Think about it. An investor over there now faces a minimum 30% tax on their capital gains, stamp duties that cost tens of thousands up front to buy a property, an incredible complex web of state and federal taxes. Meanwhile, they look at New Zealand with no stamp duty, no land tax, no capital gains tax, unless you're selling within 2 years and then you're under the bright line, or you're buying with the intention of selling, then it's an absolute dream scenario for capital migration. Because Australians are completely exempt from our foreign buyer ban, we are positioned to see a potential influx of Australian investor activity. That will underpin the strength of our property values for years to come.
It's a validation of our market's core fundamentals. I love the data from Calvin Davidson's investor poll, which showed that New Zealand investors care infinitely more about cash flow and loan serviceability than back-end capital gains taxes. That makes perfect sense. If a tax system cripples your monthly cash flow, you can't hold the asset long enough to ever see a capital gain anyway. Not to mention the fact that as a buyer, you can control your purchase price and crunch the numbers before you buy to see how affordable it's going to be for you, but you've got no control over capital growth. So you should never invest purely for that reason. We've got the ultimate environment for solid fundamentals for property investing in New Zealand at the moment with this buyer's market, as long as you buy the right sort of property for your financial position and future goals. However, if you're Australian based or an Australian tax resident, make sure you get good tax advice before you buy, because my understanding is that Australia's capital gains tax is worldwide.
So segment 3, the private rental boost, elevating the accommodation supplement. So for our final segment, we're going into a multi-year housing reform announced by the government. This is a structural rebalancing designed to streamline social housing, encourage independence and pump extra financial support directly to low-income tenants.
By adjusting the income-related rent settings for social housing, the government is unlocking an estimated $387.5 million in operating savings. The best part? Virtually all of that money is being immediately reinvested back into the private market to boost the accommodation supplement for everyday Kiwis.
So let's have a look at the facts. The government announced the multi-year social housing reform package that will increase the minimum income-related rate contribution from the standard 25% to 30%. This adjustment is expected to deliver $387.5 million in operating savings, which will be fully reinvested into the private market by increasing maximum weekly accommodation supplement rents.
The change will raise maximum accommodation supplement rates by between $10 and $30 a week, making roughly 111,000 families currently renting in the private market better off by an average of $14.91 a week. Might not sound like much, but every little bit helps when you're on minimum wage, for example.
Policy is designed to narrow the gap between social housing and private rentals, creating stronger incentives for the workforce, participation and independence. Housing Minister Chris Bishop highlighted that social housing is a high-cost intervention that must be targeted to severe need, noting that a 10% increase in tenant exits after 5 years opens up 6,000 vacancies over a decade.
And that's the people that need it the most. Social housing advocates note that New Zealand's social housing currently makes up 3.8% of the total stock, compared to the OECD average of 7%, emphasising that system stability and support pathways are critical as the country transitions to a more integrated private rental model, which, after all, is far cheaper for the New Zealand taxpayer.
By moving the social housing rent contribution to 30%, the government is finding nearly $388 million in savings and handing it directly back to the private rental sector. For private landlords, property investors, this is good news. It means that around 111,000 Kiwi everyday families renting in the private market are about to get an extra cash injection every single week via the rent accommodation supplement. That increases rent tenant stability and lowers the risk of rent arrears and ensures that regular, hardworking Kiwis have a bit more breathing room to meet their living costs.
As Chris Bishop pointed out, social housing is a very high-cost intervention. And by designing clear pathways and incentives for people to transition into the private market, we create a much healthier system. When tenants feel that stepping into a private rental doesn't feel like a step too far or a step too high anymore, it becomes an achievable goal. This policy recognises that a thriving private rental market supported by targeted government supplements is the engine of New Zealand's housing solution.
So that brings us to the end of episode 16. The future of New Zealand's real estate is looking incredibly bright.
The opportunities are right there staring you in the face. It's all about focusing on the facts and making sure that you're buying the right property for your financial position and your future financial goals.
If you want to learn exactly how to navigate the New Zealand property market, you need to come along to one of our next free online events called How to Succeed with Property Investing.
It's completely free, educational, and designed to help you to see a pathway to secure your financial future. You can find the registration link in our show notes or simply head over to propertyapprentice.co.nz to secure your spot for these live online events. You can ask me as many questions as you like, and I'll do my best to answer as many as I can in the time provided.
Thanks so much for joining us today. We'll see you next time.
Happy investing, everyone. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.